Hey everyone, this is Rahul with the Alternative Investors Hangout, and today we have three returning guests. They are from Wall Street for Main Street. They're probably one of the best places that I go to, and the reason is they lay out the facts in a simple and clear manner so all of us could understand. And these individuals from Wall Street for Main Street are Jason Burok, you have John Manfreda, and then you have Mo Davoud. Thanks for coming on, guys.
Thank you.
Thanks, Raul. Merry Christmas.
Thanks for having us.
Yeah, Merry Christmas. Okay, 2013, we've seen the stock market rise. We've seen gold and silver go in opposite directions. And we've seen emerging markets actually go down. So it just seems that a lot of libertarian-minded folks who decided to invest in, let's say, Peter Schiff's model, that did not work out this year. But BitCoin did go up as well. So let's just look at gold and silver first of all. Jason, start off.
Well, in terms of gold and silver, gold and silver started off pretty decent to go the year. You know, we had some early in the year. We had some attempts at upside breakouts, and you know these were just whacked. And on the charts, when the upside breakouts did not occur, to anyone on Wall Street, trend trading hedge fund managers, you know, people who have to make returns today, tomorrow, next week, next month, quarter, they don't care what happens a year, 2 years, 3 years, 5 years from now. That's a negative weakness on the charts. That's bearish. So when gold and silver did not break out early in the year, the people who were long, who were buying at support levels on the charts, they all turned bearish. And if you looked, you know, the short interest just increased massively. And the bullion banks who were all short, you know, they knocked us down. They came out with research reports. First of all, we could spend an hour talking about all the supply-demand fundamentals for gold and silver, so we'll just try to summarize them very quickly. But in terms of what happened, you know, early in the year, you know, you had Goldman Sachs and all these other banks say, you know, we're bearish on gold, we should sell it, it's a slam dunk sell. They almost never say that about anything else, any other stock or asset class or anything. So you could tell something was up, and they needed the gold price lower. And my guess is they needed the gold from GLD. So, you know, they knocked the price down, and they needed to shake out the loose hands. And early in the year, they did increase their shorts, but as the gold price and silver price kept going lower and lower and lower, they closed out their shorts on the COMEX to a point where now they're net long. And I never thought I would really see this. I didn't expect them to go net long. But now, you know, you have the really large bullion bank, J.P. Morgan, is net long this market. But they're at a stage here where reality is supply and demand fundamentals of the market, not the manipulated paper price, which is paper gold and paper silver. Reality is supply and demand, okay? That is mine supply, scrap supply, those types of things, and an investor or industrial demand for gold and silver. Okay, we're at a stage here where the paper prices cannot stay at these levels due to the reality of the supply and demand fundamentals. So if we do go lower in the near term, we are now at a stage, Raul, and I've been talking about this ad nauseum for 18 months now, about mines closing, that they will start closing. Mines are starting to, pretty large silver mines now, are now starting to close every couple weeks. So we're now at a stage here, Raul, where if we stay flat, or God forbid we do go a little bit lower, there will be massive mine closings, and then that will be the final bottom. And then we will probably start to move higher by the end of 2014. I'm expecting higher gold and silver prices, not way higher, but, you know, short covering, and there's so much technical damage on the charts, and Mo can probably talk about this more, but I do expect higher prices because, you know, simply put, demand is increasing for investment demand from Asia for gold and silver, and now the miners cannot supply it because they've been running at a loss for so long. They can't take on any more debt. They can't issue equity because a lot of their shares are down 60, 70, 80, or 90% in some cases. You can't issue equity anymore, and the cash on their balance sheet is non-existent.
Yeah, to add on to that, I mean, if you look at some trend charting that Jordan Trensman did over at the Daily Gold, he's thinking that you're going to have one more washout, big move to the downside, and if you look at his charts, the resistance or support could be around 17.5. But Mo, adding on to what Jason said, what do you think about gold and silver next year?
Well, if you look at the chart, if you're putting the manipulation argument aside, I mean, technically, gold and silver was long overdue for a big, painful correction. Gold has been going up in double-digit return for nearly over a decade, and silver has also been generating double-digit returns since 2009. So I think what happened in 2013 was what we needed in this gold and silver market. And going forward and looking at 2014, I think we already hit the bottom. We had that one final drop after the Fed announced that they're going to cut down the QE program, and then you saw gold and silver go down. So I don't think we're going to see it go any lower. Maybe, a couple of dollars here and there, but I think we finally hit the bottom stage, and it's going to continue to drag on throughout 2014. I'm not going to give any price prediction in gold and silver because it's just really hard to make an accurate prediction because it's manipulated in a lot of paper market and the paper market can paint the chart however the way they like it, unfortunately. So looking at the chart, I think gold and silver will be in the bottom, and I don't think will spike to all-time high. I'd be surprised if it goes up above 40 for silver and above 17, 1800 for gold. I think it'll stay in the bottom and maybe go into trading range. And then looking forward to 2015, I think it will be a better year for gold and silver.
Adding on to that, I feel that it's probably going to hover around 17.5, and the low that we had in June is around 18.50. That I see being the bottom around March. I could do a video on that later on. I'll explain that. But, John, what we saw in 2013 is that gold and silver got hammered, as we talked about, but it was the year of Bitcoin, 2013. That's what Bill Murphy said in an interview that I just saw, or I saw the headline of it. And it's really strange. I mean, Bitcoin went from around $35 a Bitcoin to all the way over $1,200, and right now it's $800 a Bitcoin. And if you look at that, you have to look in the 1930s. Gold was $35 an ounce, and it reached to $1,200 an ounce sometime in 2010-ish, 2011, or 2010. And it's just crazy how the Bitcoin price went up. So why do you think Bitcoin went up in a straight line and it hasn't crashed as of yet?
I would say mainly for alternative currencies. People want out of dollars, and they do it. Rare art, that has gone up big time. The rare coin and rare stamp index, that has gone up too. So I would say mainly it's a new technology. Technology, generally speaking, goes up a lot faster, as we know from the 1990s, technology boom. And Bitcoin's not the only technology that went up. A lot of technology like robotics, Google had a big spike. So I would say the combination of not wanting dollars and just cool high-tech gadgets. Any new high-tech gadget fad, once it catches on, it goes up, and it goes up fast. And it goes up violent. So I don't know if it's a bubble per se. It had a correction. I think in my opinion, it should correct a little bit more. I think it's just gone up so much. It's sort of reminding me of the gold and silver correction, where it went up to 1900. That's what gold did. And sentiment wasn't really bad till this year. So I think Bitcoin might have a similar 3 to 4 year correction like gold. And not only that, the governments are starting to go after it. China said no. I think you're going to see more governments go after Bitcoin, not just the U.S., but just governments in general. And a lot of them are gonna deny. So it has a lot of barriers and stuff that I think will present itself. So it'll have a similar correction to gold and silver. So, but why it went up? Simple. Alternative from the dollar. Rare art's gone up big time. Wine, and also technology. When technology gets going, it gets going and it goes up fast.
And also, if I could add a point there to John, Bitcoin, it's a momentum trade. You see hedge fund managers who, to be honest, don't give a shit about the fundamentals of anything, but the chart looks good, and they're going to chase it. I've spoken with a good amount of Wall Street hedge fund managers in the last few months. Met them on Seeking Alpha, stuff like that. People have worked at the large banks, Goldman Sachs, J.P. Morgan. They don't care about the fundamentals of anything. They don't care about what happens to the United States. They don't care about what happens to the dollar. They only care about beating expectations every single day or month or quarter to their competing hedge fund managers, and they will chase whatever chart, Raul, is going up. And Bitcoin was a tiny market, right? It was a really there's for the all-in amount of Bitcoin, right, is only like 20 million Bitcoins or something like that. But according to Trace Meyer, there's not even that many because some of the original people who got in, in 2009, they lost millions of their Bitcoins, right? They lost their hard drive or forgot their password or whatever, right? And these guys who are billionaires, who advise other billionaires, the royalty families, the Saudis, these guys who manage money for the real big shots, the high net worth people of the world, they wrote newsletter pieces about, I'm buying Bitcoin and you should buy Bitcoin too. And when you have really large money chase a small market, it's going to do things like what Bitcoin did. It's going to create enormous volatility. It's going to have, those couple $100 a day price swings, which, there's not options to hedge that out. That's insane volatility for most people. I mean, if you're using the currency, if you're a speculator, okay, maybe it's not bad because you can buy low and sell high if you stare at a chart all day. But, if you're transacting with the currency, that's something else. But I really am impressed with the technology gains that Bitcoin has. But Bitcoin has free market forces, most importantly, Raul. It's allowing people to, circumvent the dollar, like John said, but it's not being manipulated by central bankers who are creating, counterfeiting millions of extra Bitcoins, right, to hold the price of Bitcoin down. That's not happening. And, people can get in and out of Bitcoin fairly easily on a day-to-day or week-to-week basis. And, that's good. And Bitcoin has free market forces, unlike gold or silver right now.
But the thing is, how do we know that central banks aren't buying Bitcoins or governments? That's
we don't.
We
don't, but they're not counterfeiting the amount, so it really doesn't matter if they're creating extra volatility, you know what I'm saying? Because, the thing
so they're
about
not naked shorting it.
Is as long with the Bitcoin supply, as long as someone is not counterfeiting the amount of Bitcoin, because, obviously it's going to show up in the blockchain if someone's trying to hack it, right, and create more amounts of Bitcoin, right? It's going to show up in the code. People are going to see that, some weird program is trying to get in and try to create an extra 5 million or 10 million Bitcoin, right? That would show up. So that's not happening yet. But, yeah, obviously governments, if more people keep adopting online, using Bitcoin, more people than the speculators. Because the speculators are only there as long as the chart pattern is good, right? But I'm talking to actual people that transact in the currency. So that number continues to increase rapidly, like more online websites accept it, more bricks and mortar stores and shops and stuff accept it. Then we're going to probably see governments say, people aren't paying their tax bills, and they're going to figure out a way to step in and tax it or destroy it or something like that.
Yeah, I see problems.
Well, we already saw China stepped in and said, don't accept it. So, yeah, I do think governments are going to step in because they'll do whatever it takes to protect their monopoly.
And adding on to this subject, Mo, what would happen when the Winklevoss twins, when they come out with their ETF, won't that create some dislocations within the Bitcoin market?
I think that once they come out with the Bitcoin ETF, it'll give investors easier access to Bitcoin, which might help inflate the bubble that it's currently in. I'm not sure when that's going to come out. I heard it might be somewhere in 2014. But I think Bitcoin is a good alternative from holding U.S. dollars instead of buying U.S. dollars. You see people buying Bitcoin. It's still fiat currency. It's not backed by anything. But if you compare it to the U.S. dollar, I'd take Bitcoin over U.S. dollar any day right now.
Yeah, I still have problems with Bitcoin because I see no intrinsic value in it, even though I hate the U.S. dollar. I mean, I don't like fiat money.
There's copycats coming, Raul. where the
Litecoin.
guy from eGold, I don't know if you saw this, but the guy from eGold, who, by the way, he got fined millions of dollars and he got put in prison for a few years, he's coming out with a virtual currency similar to Bitcoin and Litecoin in technology, but it'll be backed by gold or silver in the vault. The thing is, when you put the reason Bitcoin has succeeded as long as it has is because it's decentralized, and there's not one central point for a government to, attack it and shut it down, right? Which is why the predecessors to Bitcoin got shut down so easily, like eGold and Liberty Reserve. So, if he starts putting vaults, in theory it sounds like a good idea, but if you put, a couple vaults with a lot of metal, you put yourself as a big target for the governments, and the governments are going to say, the criminals, the drug dealers, all the people that do illicit transactions, the money launderers, they're all doing their illegal transactions in Bitcoin, pretending, that they don't do the same thing in the dollar and in treasuries when you have these large banks getting fined hundreds of billions of dollars as a slap on the wrist for laundering, drug money and stuff like that from the large cartels. So it's all hypocrisy, it's all bullshit. But, it's exactly like what John said. They just don't want competition, which is why they've manipulated gold and silver so much. Unfortunately, I've seen a lot of people get discouraged on gold and silver in this correction, and a lot of long-time gold and silver bulls are giving up. But, it is what it is for right now, and I think it's still an amazing deal to buy metal as an insurance policy, and there's amazing investment opportunities in the commodity sector. But, Rel, weren't we going to also talk about the general stock market for a review of 2013 before we talk about 2014?
Yeah, we could talk about that.
I actually want to say something since Jason brought up the gold and silver bulls giving up. I listened to 2 interviews, one with David Morgan, the other with Jim Sinclair. And I would say I definitely think history is repeating itself because David Morgan said he saw so many people just throw in the towel when gold was at 90 because they were so deep in the red.
When was that, John? Was that at 74 or 76?
76. Well, that time period. I don't know exactly when, but it was in the middle of the deep correction in the 70s. And he said he saw so many people throw in the towel, and they missed the biggest, most profitable swing. And, we're seeing that. And Jim Sinclair also said the other thing, that most of the people who made money off the 70s run, and we're seeing it today, were the bankers who went long bullion when everyone hated it, and the sovereign wealth funds. And I think you're seeing that now. China's buying up, the People's Bank of China's buying up tons of gold. Central banks from around the world are net buyers in 2013. And as Jason said earlier, bullion banks are all hugely net long. JP Morgan's covered the gold market. So I hope that doesn't happen again. I hope anyone that has gold and silver don't give up because I hate to see that happen again.
Yeah, if you look at it, I just see a lot of negative sentiment. I was talking to John about this the other day, and you see some YouTube videos really negative, or people have turned ship, and that's when I want to start to get back in stacking. I haven't stacked since like 15, 16 months aggressively. So, anyways, yeah, let's get into the review of the stock market of this year, and then we could talk about 2014. But looking at 2013, we saw huge returns in the Dow. I actually did a report saying that, okay, I see so many bulls right now in the Dow, and in addition to that, it just seems that markets probably won't go up in a straight line. You're going to see some sort of nasty correction come about. But putting that aside, Jason, what do you have to say about the stock market? Is it because of earnings, that's what some guys are saying, or is it because of all this easy money created by the Fed, or these guys on Wall Street have no idea what they're doing, or they're going to try to bait retailers who are now coming into the market?
Well, there's a combination of factors that you can make a good argument for, but there's 2 main factors that I would add. And, when you talk about earnings, that starts with the money from the Fed. Because if you're a real business, right, and you want to grow your earnings and you don't have cheap capital available, you have to increase profit margins and you have to grow revenues. And the large cap companies that are listed on the New York Stock Exchange and the NASDAQ, the companies in the Dow and the S&P 500, if you go back and look at their income statements over the last handful of years, they have really not grown their revenues at all, and especially not where the stock for stock price valuations and stuff have gone up that much. What has happened, in my opinion, is all global central banks, not just the Federal Reserve. So you have the Japanese central bank, you have China printing mass amounts of money on their dollar peg. You have these other countries either on dollar pegs or manipulating their currency with a fixed exchange rate. And that creates excess global liquidity, a massive amount of it. And the emerging markets, because they're more dependent on real economic growth, and they've been getting just absolutely hammered with real inflation, humongous real inflation compared to the developed world, a lot of the capital that was there, for over a decade, through around 2010, 2011, that money has started to come into the U.S. as a safe haven. It's also gone into other assets in other countries too, but it's mostly gone into the U.S. general stock market, U.S. real estate market, and U.S. bond market as a safe haven. So that's flight capital is one of the reasons, and the other one's global excess liquidity. And you add that up with the cheap capital from the Fed and the corporations, these large cap corporations, which have, cash flows already, right? They're not growing their cash flows really. The revenues are either stagnant and they're increasing 1 or 2%, or they're declining, but they're buying back their shares with that cheap, they're doing a debt for equity swap essentially. They're taking that cheap capital, which, Intel can borrow or Verizon can borrow many billions of dollars for 2-3%, right? For 20 years or 30 years. You have MLP companies, which are oil pipeline, which have consistent cash flow. Some of these guys can borrow at really low rates for 50 years, okay? And they're taking that cheap capital and they're either buying up other companies, on leveraged buyouts, which you're starting to see that, or they're buying back shares. And for your listeners out there, there's a really good piece on this. It's David Einhorn of Greenlight Capital. He's kind of a libertarian. He's a great long-term value investor, pretty good at shorting stocks too. He wrote a pretty long piece on this in his October 2013 newsletter about the games that the large cap companies are playing with their earnings, and their stocks are still going higher because of cheap capital and other stuff. So in a lot of situations, Raul, you have a company where they've talked down with the analysts covering the company. They've talked revenue and earning estimates down from 6 months before or a year before. They've talked them down 40 and 50%, right, to a much lower bar. And then the company either barely beats the bar because of accounting gimmickry, right? Because you're an accountant, so you can move the numbers around a little bit and beat earnings by a penny, right?
Yep.
And that's exactly what happens. So you don't have revenue growth. You have the revenue and earnings actually slashed on the estimates by 40 and 50% in some cases each 6 months or a year. For the large cap companies, this has been going on for at least a couple years now, and the stocks go higher and a higher multiple. So who would want to pay a higher multiple for a stock, Raul, where they're not growing revenue, they're artificially raising earnings, due to cheap debt because they buy back shares and lower the share count? It's all on a sea of global liquidity then, or there's no other option. You know what I'm saying? People are so desperate for a yield or just to have any type of return because the money market funds and other stuff are just non-existent. So that's what I see in the large cap market. I mean, with a small company with entrepreneurs, even amongst this inflation and rules and regulations, people will still, a great entrepreneur, it will be harder for them to do this, but they will still be able to adapt and figure out a way. And the small cap companies, don't have that easy access to cheap interest rates and things like that. They have to grow or die or innovate or die. So that's what we're seeing in the market here, where a lot of money is going into, these large cap companies. The market is paying a much higher earnings multiple for them. It's paying over 18 times forward earnings for large cap dividend stocks that are not growing, that are actually contracting in terms of their revenue. But their earnings are growing because they're buying back shares with cheap capital from the Fed.
Yes, and when earnings come out negative, and since they bought out all these shares outstanding, that's when SHTF, or when you're going to see the stock market go down. But John, go ahead.
No, go ahead.
Okay, so Mo, how do you analyze the stock market this year? Do you agree with Jason's analysis that it had to deal with the Federal Reserve cheapening money, and also besides that, in my opinion, it had to deal with the yen carry trade on steroids, just like you saw in the mid-'90s and what happened from 2003 to 2007, you saw this yen carry trade on steroids, and you saw all this global liquidity propping up stock markets. But then when this carry trade unwinds, that's when all these stocks will most likely fall off the edge of a cliff.
And that's correct. For 2014, for the stock market, I don't see anything different changing from what happened in 2013, mainly because the Federal Reserve is still printing money, and a lot of money, despite they said that they're going to cut down. It's only $10 billion, and it can be $5 billion in the bond market and $5 billion in the mortgage-backed security market. So it's not really that much. I know people make a big deal about it, but they're still going to print 75, even
that's
maybe
just
more.
That's just the direct stated
they
amount.
they're also not including backdoor bailout for other banks in Europe and etc. So
And reinvesting
paper,
interest payments either.
Right.
Yeah, and so on paper it's going to be $75 billion, but if you look beneath the number, it's a lot more than that. So because of that, the stock market, I think, will continue to go up. We'll still see small corrections like we saw in 2013, like what we saw in this past September when the Dow took a small correction because they're worried that they might taper. When they didn't. So we'll still see small correction, but for the market in general, I still think it's going to go up. Look back into 2013, the companies that profited the most are the Japanese companies like Toyota and all the other Japanese manufacturing companies that do a lot of business overseas. If you look at the earnings for Toyota, ever since the yen got devalued, because Toyota, a lot of their business, most of their business they make is overseas, they had a great year in 2013. So I think that if you talked about the yen carry trade, if you look at what happened to Toyota, that's a good example of when a foreign currency devalued. There's some positive effect for multinational companies if they have.
That's only in the short term, though.
Yes, only in the short term. Eventually, it all explode. And so that's my outlook for the market in general, 2014.
And I think for this taper, Raul, that it's all about trying to slow down the manipulation and the management of markets. Every single market, Raul, to one degree or another, is managed or manipulated. Some the Fed and other central planners care about more than others. You know, maybe Bitcoin's a free market for now, but I'm sure that'll change with regulation and other stuff that they attempt to put on that market. But in terms of the stock market, you know, you have the general stock market index, like the Dow and stuff, go up 25%, and the small cap indices, which actually have to have revenue growth in a lot of cases, go up 35%. But, you know, the Fed does not want stock markets going up 25% per year. Because then that, you know, that will start to confirm that that's a bubble. But I think the Fed is trying to manage asset prices higher, you know, 9, 10, 15, maybe up to 15% higher per year, where, you know, it goes up a little bit each year, maybe a little correction thrown in like what Mo said, and I think the Fed wants to do that. And then you add in the fact that Wall Street and so many of these banks and stuff are holding these assets, these real estate portfolios, their bond portfolios with the interest rate swaps and other garbage, and then their stocks with so much leverage, they're buying assets with leverage. They're not just buying and holding assets, they're buying assets on leverage, you know, with the yen carry trade, or in the over-the-counter derivatives market with other junk. And, you know, everyone is so levered to this point where if we have, you know, a 15, 20% or more correction in asset prices, they're going to be having to do bank bailouts again. So I don't think we're in that stage in 2014 where we're going to have an asset price collapse, because part of our thesis, like, I don't know, Mojan could talk about this too, is that I believe we are in the early stages of the von Mises-style crack-up boom. And in the early stages of the von Mises-style crack-up boom, you have all the quote-unquote benefits of inflation. You don't see as much inflation in the real economy, in food prices and other things, especially here in the developed world. A lot of that inflation has been exported. It's going to go into the supply chain there. It's going to take a while for that inflation to really compound and then come back through import prices to really start accelerating. But the inflation now is in asset prices, and, people are happy. So if asset prices are going up and the Fed believes is 100% committed to this stupid wealth effect, that, if your house price is going up, your stock portfolio and 401k is going up, you're going to start going to the mall and spending more money every single month or something like that. And I think the Fed is committed to this strategy until the end, until all fiat currencies, with the dollar being saved for last, are completely and totally worthless. I think they are committed to the strategy. So I think we're going to see management here of the crack-up boom, where asset prices are tempted, especially the stock market, because most people have most of their net worth either in their houses or their 401k plan, where the stock market is going to go up. They're going to try to manage it 10-15% per year higher, maybe throw in a correction here or there, maybe adjust the QE if we have the correction, the Fed adjusts QE higher, right, back to 85-90 billion, right, on the stated amount. And then when the stock market goes up again, reduce it again, we're going to have that type of Keynesian BS lever pulling.
Yeah, just the only thing about the von Mises crack-up boom, I agree with your long-term thesis, just the time frame, that's so difficult with these screwed-up markets. But, John, going back to inflation, I think for 2014, I think that's when you're going to start to see a pickup in inflation. Even Joe Wiesenthal of the Business Insider was talking about how 2014 you're going to see more inflation. So now if you have more inflation, won't that just hurt profit margins? And you have to also add the fact that consumers are going to be tapped out because of Obamacare. And it just seems that there has been so many bulls in this market. And if you look at the inventory numbers as of last quarter, you have to look at the fact that GDP was boosted up because of all this excessive inventory, and that inventory has to be liquidated at some point. And based on the retail sales, what happened with these online retail sales, it just seems that earnings could, for some reason, you could see a lot of these stocks go down because they're going to miss earnings. So how do you think about all of that?
Well, I think we're already starting to see some of it in the food stocks. Campbell's didn't really have a spectacular earnings, and that's because, beef prices are at all-time high. We're starting to see a little bit of inflation rotation, I think, in the food sector. That's what I think. We're definitely seeing it in the bond market, the debt market, as Jason said, bond stock, debt market. But I think it's creeping up to the food, and I think it will start creeping into oil and energy next year. I would say that will be the beginning. I think we're going to see the beginning of a sector rotation. Will it hurt companies' bottom lines? I would say in technology, no, because technology is a simple, less government-regulated industry, and it will continue to do well. They'll replace human capital, human labor with robotics.
Like Google?
Yeah, so like Google and other products. So I don't know how much it will hurt their bottom line, but it will. It will start to hurt its bottom line. It might start beginning at the end of 2014, but I think that's something longer term. So there's a lot of, but it's definitely on the horizon. You're seeing it hurt the mining companies because costs are going up. Oil companies' costs are going up big time. A lot of shell producers, they have such low profit margins. But we're starting to see it. And it's also perception. Fed has done a good job of managing Western perception. And also Wall Street traders trade around government numbers. So how far can the government fudge their numbers to keep this market up? We don't really know. I think they might be able to continue to do it. A lot of people who are on unemployment for a significant period of time now, they are no longer counted because they've been unemployed, and they count them as leaving the labor force when they didn't really voluntarily left. They were forced to leave. So there's a lot of things that I think can continue to happen. When do we reach the breaking point where the government fudging doesn't affect the market? I think it will be happening when products we're normally accustomed to getting, we just can't get. Or not that we can't get, but they're no longer cheap. And that's what I think it is. So Like another example of companies being able to increase their bottom line is through books. They do it either through ebooks now, and their costs have come down.
Yeah,
Mo.
so you do have some free market forces displacing then some of the inflation. That's one of the things, why we didn't have this inflation really bad roll, in the 90s, because if you go back and read the literature, you saw the budget deficits were starting to explode then, but you had the internet revolution and other people's costs being cut. You had jobs being outsourced and offshored, because of telecommuting and software programs and other things. And, technology helps offset some of the inflation. Now, it can't offset your food inflation and other stuff, but it can offset, as a business, it can offset some of your other costs.
Mo, though, but can't you get all this inflation coming out when the banks start lending money again? I mean, when you see interest rates rise, the incentive for banks would be to start lending out money, and because of this fractional reserve banking system that we have, when that money goes out, then you have the money multiplier effect taken to effect. And as a result of that, that's when I see the nasty inflation, worse than the 1970s.
Yeah, I think you're talking about the increase in money velocity. Once we get that, then we'll start seeing higher and higher inflation. But in reality, all the banks that took the cheap money from the Federal Reserve had not lent it out into the economy at all. So that's why we're not seeing higher or hyperinflation like we saw in Germany or Zimbabwe.
Yeah, there are a few different things. Zimbabwe had their debt denominated in a foreign currency, and then Germany, they just decided to print all this monopoly money with an MMT guy, professor or economist, from like 1905 to 1919. I don't remember that.
Right.
But
I just want to add something about the velocity. I would say it's more perception than velocity, because in 1999 the velocity of money was at the all-time highest, and we didn't really see big inflation, but we saw it the next decade, and velocity kept plummeting. So I would say it's more perception. Like what happened in Weimar is farmers stopped selling their food because they didn't want dollars, because prices kept going up and up and up. Something like that could happen, and that's when we could see the nasty. But I'd say it depends on, there's going to be some sort of event that changes perception. It could be just when they announce another stimulus program. In the future, interest rates are up, they hit 3% on the 10-year today. And once the perception that they have to keep printing to keep low interest rates, they can't keep interest rates low without printing, that could be when it really picks up. So I used to think velocity, this is just my opinion, but I'm not that big on it. I think it's going to be perception.
And then the breakup of the dollar pegs.
Mm-hmm.
Yeah, I mean, Raul, as long as the money isn't lent out in the banking system, lending and spending, and the majority of inflation can be directed to either exporting it to the developing world, right, where they, have to swallow that shit sandwich, or it goes into the asset prices, right? The people here in the U.S., most of them won't wake up and won't see it. It'll only be, people who really understand what's going on, like us, who understand. The people I talk to on Wall Street don't even understand this stuff. They don't care. Most of them only understand what's going on in the U.S. They trust the government numbers. These are people who manage a lot of money. And they only care about they don't even care about what happens a year or two from now. So these are people that are saying, there is no inflation. You're a conspiracy theorist. Gold's going to 800. All the miners are going bankrupt. There's no demand for metal in, out of Asia or China. Supply demand don't matter. There is no inflation in the developing world because I don't see it on CNBC or anything like that. So
Indeed.
Yeah, so that's the general sentiment for a lot of the people on Wall Street who manage money, unfortunately. Their perceptions will change. You're starting to see that a little bit. A few of the Wall Street people I've heard that do podcasts, they say, well, the government says this about inflation, but my grocery bill goes up this much every year, and my wife keeps asking for more and more money, and the portions of my restaurant are declining a lot. But I don't know if that's inflation. So I guess it's just, the brainwash and the programming that we've had to overcome.
Yep, that's what Paul Krugman says. There's no inflation, but he's a nutcase. But anyways, I wanted to finish this off by having all three of you lay out some final points that you see for 2014, and I'll start with Mo.
Thank you. For 2014, we haven't talked about the technology sector that much, but one thing that I think will be a game changer in 2014 is Google, and they're probably going to come out with a Google Glass in 2014. I think that would be a game changer in the personal gadget industry, and I think the Google Glass will be a benefit to Google like the iPhone was to Apple. That's how much I think it will be a game changer. I know we see Apple and then Samsung develop the watch that comes with your phone, which is okay, but the wow factor, if you want the wow factor, the Google Glass has the wow factor. I mean, it's going to do a lot of different things that make your life a whole lot easier compared to the watches that's coming out in 2014. So if there's one large cap technology stock or any stock in general, large cap stock in general that I would bet on in 2014, it would be Google.
John.
Well, I just think that this will be the year that a lot of depressed commodity sectors finally start to recover. They'll be able to slowly take off their Band-Aids and heal. I would say North American natural gas will go up a little bit. Say uranium was going to start to recover. I definitely think gold and silver will recover. I think it will be either a stimulus catalyst or right now the COMEX just got rapidly drained this year. They're at all-time lows. This can't last forever. So I think the resource sector especially, and there's a lot of, I think the oil juniors will do well, and I think foreign oil companies will do well. I think shale oil, they're going to go through a big correction this year. I think the hype of increasing U.S. production will drive prices a little bit lower WTI, and a lot of shale oil will consolidate and correct. So that's what I'm looking for 2014.
And Jason, finally with you.
I have a list. So I have 10 points. I'll try to summarize them very quickly for your listeners here for some predictions for 2014. I expect the general stock market indices like the Dow and S&P 500, we may have a little correction coming up, but I expect them to end 2014 about 10 or 15% higher, the large indices, just because there's going to be money that's leaving the developing world, and also because other countries are printing more too. So you have Japan and other countries that are still printing, even if the U.S. has quote-unquote slowed down with the taper. I think for gold and silver, I think the bottom is very close if it hasn't already occurred, and that will lead on the charts to a very strong double bottom. Mines will shut off soon, and then by the end of 2014, I think we'll see $1,500 to $1,600 gold and silver in the $25 to $30 range by the end of 2014. Because to be honest, if it doesn't go to those prices, there will be no incentive once the mines shut down to bring those other mines back online, because those are the minimum levels for them to be profitable. I think the yen, which is now above 104, the yen has finally broken support level on the charts. I think we're going to start seeing the yen accelerate on its decline. Japan has been printing even faster than any other country probably in the world. Their bond monetization and devaluing of their own currency. I think we could see 115 to 120 on the yen by the against the dollar by the end of 2014. I don't think Japan's quite ready to completely blow up yet, but I think that's coming. They're probably the first developed world country to go. And I just think it's really funny how the Bank of England is not really running trade surpluses, and yet they have a current account surplus. So where did those couple $100 million extra come from for them to start buying U.S. Treasury bonds? Anyway, though, let's move on down. Yeah, backdoor bailout or whatever. I print money and hand it to you. You print money and hand it to me. It's not inflationary, blah, blah, blah. All the developed world is doing this BS. Let's move on to oil. I think oil is going to stay in its trading range. I think John mentioned that. I think there is a lot of money as an investor to be made in oil. The shale producers are momentum stocks right now. They are not value plays. There might be a few here or there that are value plays, but in general, these things are selling at 18 to 23 times earnings right now. They have no dividend. They do not have good margins compared to other oil-producing companies. And one of the oil-producing companies, shale producers, EOG Resources, is selling at 40 times earnings. That one is quality, but I don't really like any commodity producer that's not a royalty company at 40 times earnings. But in general, the oil industry will have to spend over $600 billion, be with $1 billion per year, just to keep production levels flat. So that is a lot of money in contracts and capital investment for pipeline companies, for oil drillers, for fracking sand companies, for water cleanup companies in the oil industry. There is a lot of money to be made in the oil technology stocks for companies like that with a lot of guaranteed contracts. And I would also look outside of the U.S. for value. You can find oil producers with good revenue, earnings, cash flow, reserve growth, production growth at around 10 times earnings. I think Google, I agree with Mo, I think Google is the large cap technology stock to own. If you're a momentum trader or a value investor, they're in a real sweet spot. They got Google Glass, they got the Chromecast, and they just bought a ton of robotics companies. I think they're going to revolutionize the robotics industry. It will not just be those dumb robots that are, moving heavy parts like in Iron Man, where people laugh at them, they do a little thing. I think Google is going to do some amazing things in robotics in our lifetime, and I think they're going to be the industry leader for the rest of our lives in robotics. And if you read a book on Google called In the Plex, you realize that the founders of Google, Sergey Brin and Larry Page, have been very big proponents of robotics and artificial intelligence their entire adult lives, and this is where they want to invest. They're waiting for the hardware part of robotics to catch up with the software programs and algorithms and stuff, and finally, the hardware is finally getting there to catch up. I think interest rates may actually spike temporarily above 3% in 2014 to maybe 4% or 5% on the 10-year. I know people are calling for lower interest rates, but we may get a spike temporarily, and that could, trigger blow up in the interest rate swap market, and that could trigger a European bank like maybe Deutsche Bank to go bankrupt or need a bailout or something. So you might see, them arrange behind the scenes, the central planners, to have, J.P. Morgan or, I don't know, someone else split up all the parts. There's a lot of different scenarios, but I think there could be a large European bank that may need a backdoor bailout or split up the parts and buy out or something like that in 2014 or 2015. I think there will be more Arab Springs and Cyprus-style bail-ins coming in the next couple years, especially in developing countries in Africa, Middle East, South America, and Asia, because they have the highest percentage of annual incomes spent towards food and gasoline. It's over 60%, a lot of these countries, so it's very sensitive. And Cyprus was a trial run. So if you look at the IMF documents that are coming out now, some people like Paul Krugman and Larry Summers are writing about bail-ins instead of bail-outs. And legislation has been changed in countries like Canada and the U.S. I don't know if it'll occur in 2014, but in the next couple of years it's a very possibility. But I think these will be tested more in the smaller periphery countries in the European Union, like maybe a former Soviet country, Soviet bloc, or a developing country where they do a bail-in or there's a political revolution due to higher food prices. And finally, last but not least, I agree with John Manfreda. I think this commodity cyclical bear market for precious metals, food prices, and a lot of energy has finally ended. So I think we're going to see the uranium price start to move. I don't know if we're going to have a big super spike or whatever in uranium in 2014, but the producers cannot make any more money, really, at these low prices, especially the ones that just started producing. So there's a lot of fundamental factors that are going to start moving uranium higher, Fukushima notwithstanding. I'm talking like China putting nuclear power plants online. I think platinum and palladium have a lot of good tailwinds. I think precious metals will put in a bottom and start to move higher. I think even coal has bottomed because India has started buying up a lot of it. And, natural gas and oil look pretty good to me too. And last but not least, besides the commodities cyclical bear market ending and starting to move a little bit higher, which means inflationary pressures, unfortunately, but if you're a commodities investor, that's good. You'll hedge yourself. I think inflation or deflation, I think smart, brilliant, hardworking entrepreneurs in the technology industry, in industries like 3D printing, robotics, big data, data mining, cybersecurity, software algorithms, mobile technologies, miniaturization technologies of existing technologies, biotech and others will continue to flourish. One of the keys for this industry that the other industries do not have, the industries tend to generate profits fairly quickly, not counting Twitter. Not counting Twitter, Amazon. These technology industries, companies tend to generate profits fairly quickly. They generate free cash flow, and the industry is very well, Silicon Valley in the United States is very well capitalized. They do not need to go and borrow a lot of debt. There's a lot of cash to finance growth there without debt.
All right, that sounds excellent. And
I just wanted to add one more thing. In terms of inflation, electricity prices are at an all-time high now, and that is according to the BLS government numbers. So how much higher they are now than they were, who knows those numbers. So I do think we're just seeing inflation.
Indeed, we are seeing a lot more inflation than what the U.S. government is saying. And before I end this podcast, I just want to remind all you guys listening at home, if you are a new investor, please go to your financial advisor to try to seek some financial advice. Over here, these are just our own opinions. We're not telling you to go, or these are just our opinions. So just remember that. And if you're a sophisticated investor, I always advocate you guys to do your own due diligence and your own homework. And before I end this, my own thoughts about 2014, I just see a lot of people really positive when it comes to the stock market, and when you see a lot of bulls out there and not so many bears, and the fact is that you have inventory numbers going up, those you have to have good earnings coming out next quarter, second quarter, in order to see the stock market go up. I frankly don't see that compared to these three out here. And in addition to that, what I do see happening is you're probably going to see a rotation from stocks to commodities to foreign markets. In addition, maybe other natural resources. Maybe you could see it go to uranium. So it just seems that there could be a cyclical shift based on my opinion. And before I let you guys go, how can people follow your work again, John?
Oh, me? Oh, okay. Well, obviously, Wall Street for Main Street is our website. It's WallST for Main, st.com. We are on YouTube. That's our podcast channel. We are on Facebook. You can just type us in. And we're starting to add some things to our email list that you can't get on YouTube. So sign up for our email list, and we're going to have some updates and current event stuff coming out soon.
And John or Mo, you have anything else to say?
No. If people want to subscribe to our email list, they can go to our website at wallstreetformainstreet.com. And if they also have any additional questions, they can email us at wallstreetformainstreet@gmail.com as well.
Jason, anything else?
Yeah, I'll just say something. If I had to summarize what I think is going to happen in 2014 compared to 2013, I think 2014 is mostly going to be a continuation year of 2013 trends, except for I think commodities have finally bottomed due to the fact that the people who have to work their ass off to produce the commodities can't make any money. So commodity prices have to bottom here, especially when demand is actually still rising for many of the commodities globally. But that's really all I would add. And, there's just so much manipulation in all of these markets, Raul. There's so many games played, like with the earnings numbers and stuff like that, and, the analysts are forced to lower their earnings and revenue projection, or they get fired because the CEO of the company who's covering them threatens their boss, or they're an investment banking client, and, they have a privileged relationship with them, and, they bend over backwards to take care of them, and there's just so much intervention and manipulation in all these markets. It's very tough to trade and invest in these markets, but yet people still need a return. So if they need help getting through that, Wall Street for Main Street does paid consulting work. We can teach people fundamentals of any market, really, or how to use technicals to trade it, how to hedge your portfolio position. We do asset allocation strategies for very high net worth or beginners. And, if they want to reach out to us, Mo already gave our email address. We develop customized educational and consulting work and tutorials and stuff like that for people who want to learn or want to protect themselves in these manipulated, disastrous markets that we have, which are, not acting like they're supposed to, because obviously you're not supposed to have every single market, stocks, bonds, real estate, all go up at once.
Alrighty, that sounds great. Thanks for coming on, guys.
Thank you.
Thank you.
Thank you.